Live from the rooftop of the Hermann London Real Estate Group in beautiful downtown Maplewood, it's the St. Louis Realtor Podcast with your host, Adam Kruse.
Welcome everybody to the St. Louis Realtor Podcast, live from the offices of Adam Kruse here. This is episode 36. The jig is up. We don't do it from the rooftop. But I'm Adam Kruse, and I wanted to introduce my co-host here, Shannon, Realtor extraordinaire. And what's going on, Shannon?
Hello.
And so we also have John Charlton here, our guest of the night. We'll get to John in just a second. I wanted to give a couple quick Hermann London updates. We had our business planning retreat last week in the cold, but it was awesome. We had some really good marketing ideas that the agents shared with each other, a good team collaboration. I think getting the group together and sharing ideas and sharing experiences and helping each other. There was a couple times where people had to share a problem and people shared their solutions type of thing. That's kind of why we call Hermann London a family, And so that was cool. I'm going to give an update on, I haven't really talked much about investments in a while. It's probably been like 30 podcasts since I really talked about any of my real estate investment deals. For a while I was giving an update on them. But I've still been buying rental properties. And I bought actually 4 last week. And we've been buying these properties. I've been buying with a partner, Brian, for an average of around $25,000 purchase price, $20,000 to $25,000. The rents are $650 or so. And the crazy part is our payment is our payment's $150 a month. So it's just kind of crazy how that math works out. Let's see here. I wanted to give an update that we have a CPA coming to our office next week. He's going to give us some tax tips, and we're just trying to continue to bring in other experts to the office and help our agents. Part of our mission statement is to educate our clients and our realtors. So we got the CPA coming in. Last update, Krista, one of our agents, was excited. She got multiple offers on one of her latest rehabs, and it was kind of fun. She went live too, and she shared her tips and tricks that the agent who wrote the winning offer used to basically get Krista to get her seller to accept that offer. So,
what were those tips and tricks?
Do we want to share them?
Yeah, why
Let's
not?
Share them. Okay, so number one was that the agent, I guess there's kind of 3 things. And so number one, the agent was calling Krista and sort of chatting her up, building a relationship and starting a rapport and making her be someone that Krista would want to work with. Number 2, the agent, when they sent the offer, they had the lender, this is a good tip for us, John, they had the lender text message Krista and just introduce himself and basically strengthen in Krista's and her client's mind, strengthen, I guess, the purchase power of the buyer, and then lastly, the buyer's agent, scheduled their inspection before the offer was even accepted. So I think all of those things, would they make an offer that? So
that's pretty bold, though, because to go out and schedule the inspection prior to the
they can always cancel it. I think what they're doing is they were showing it is
that they're on the ball.
Yeah, I think they were showing Krista and the sellers that they're on the ball, and Krista could be like, well, this buyer is really on top of it. I think this is going to be an easy deal type of thing. If someone else offered a lot more, I'm sure they would still go with
So was
the
this,
higher
in fact,
offer,
the highest offer?
I don't know.
Okay.
I'm wondering also about time frame. Like, were they letting her know that they were going to be able to close quickly?
Yeah, actually, you're right. I forgot to mention that. They did like that. Krista liked their time frame for when they're going to be able to close, and so, which is cool because I know you're all about you guys can do quick closings now and all that kind of stuff.
Quicker the better.
And I guess I could let Shannon talk about herself, but she's been working on a lease purchase deal down in the Cherokee area.
Yes, it's on California. So the seller is wanting to sell the house, however, is open to the option of lease purchase, which simply means that you would lease the property for a specific amount of time to be determined by the buyer with the intention of buying the home after that lease is up. So, and it can be anywhere 3 months, 6 months,
A year.
a year.
It's interesting, though, because those deals are really hard to market, right? I mean, we have it listed for lease. We have it listed for sale. But you can just check a box on the sale thing that says that it's available for lease purchase, but you can't really list it for lease purchase. I think if someone's wanting to do that type of deal, it's hard for them to find them.
Yeah, I don't
probably.
think you can actually search that.
Well, a realtor can, and special terms, I think it is.
Yeah,
there a
in the
special terms
MLS, but
section?
someone on, say,
But someone
Zillow
on
or
Zillow or
Realtor.com.
Realtor.com can't. Yeah.
So, but if you're interested in the Cherokee area, it's a huge, huge house, though.
Mm-hmm.
It's 5 bedrooms, 3 baths. It's 3 floors, 3 levels. So it's a huge home.
What's
I
the
was-
asking price for sale?
$250.
$250. Is that a fair price in the area? I mean, is that on the low end, high end?
This is probably one of the biggest homes in the area, though, and I think that that's been a hard place to price it, just because it's
big.
it's got so much more
Yeah.
square footage than most of the homes around
Mm-hmm.
there in that immediate area. And like anywhere in the city, it's all about pockets, so you can't skip over to the next neighborhood and appropriately pull those in as comps either.
Right. Yeah, and on a lender's perspective, I mean, I get people all the time that are maybe not qualified to buy, and they inquire with me, well, how would a lease purchase work? And I mean, I'm always like, well, you're just going to have to talk with a realtor, to find a property like that. So there is interest in that type of property. It's interesting that it's hard to locate. You know
It
what I mean?
is. Do you get a lot of interest?
Sure. Yeah, I mean, predominantly what you have is you have people that have a credit issue, typically, that like they have a good job, they're ready to buy, but there's restrictions in terms of when you can buy. So they don't feel like they want to get themselves into a 2-year lease if in 6 months they're going to be past that point. where
Or
they can
even a
actually-
1-year lease
Yeah,
if you're talking 6
exactly.
months then in that scenario.
Right.
Which is what most people want their tenants to sign is a minimum 1-year lease.
Sure.
So,
Yeah, and
Okay.
I've had some experience too, like in terms of hearing about people leasing a property with a purchase option, and then the people not ended up doing it. In which case, there's a lot of times earnest money's exchanged, stuff like that. So I mean, it's an interesting idea as a land or as a property owner too, to think about, well, how serious will these people be? What do you need in terms of incentives to kind of make them, get to the point of buying? Does that make sense?
yeah, but usually you're signing the contract when you're signing the lease as well.
Right.
So that kind of plays a lot into it. But I think is the benefit of a lease purchase too, oddly, is you get to actually quote unquote try out the house.
Right.
Just kind of see that it meets your needs, or that things are as they appear, where most buyers don't get that opportunity.
Okay, so tonight we have our special guest here, John Charlton, with USA Mortgage. Sits literally right on the other side of this wall, right? And he's been on the podcast many times. He's given us the mortgage update. He's taught us about a lot of different things. But Shannon's put together this big list of questions.
As I always do.
Yeah, it's as you always do, and it's good. So what we're hoping is that people will, ask their questions. And I was just eating dinner at the Post, and a guy called me, and he wants to buy a house, and he was kind of like, "What do I do?" And the first thing I said is, you got to call John and to get pre-approved, and so you know what you're talking about. You know what kind of you can afford. So, Shannon, do you want to talk about your Webster deal, or should we just jump right into?
Let's just kind of jump right in since we spent so much
Let's
time
jump
on the
right
lease
in.
purchase.
Okay, go ahead.
Okay, so first of all, what I'd like is an update. I think there's so many questions on the tax reform.
Mm-hmm.
What do we know?
As far as how that affects mortgages?
Yes, us as home
Oh, I
buyers
never
and
thought of
sellers.
So I guess one of the things that is kind of strange in the economy is that typically mortgage interest rates go up when the economy is booming. Just what's happening right now in the market's actually a little bit puzzling, because interest rates are staying low, even though the Dow Jones and all the other indices are at like all-time highs. So to answer that question, I would say right now it doesn't mean a whole lot, because basically interest rates aren't doing much. There is anticipation that they will go up over time, and that the Fed will be raising interest rates. As far as the Fed funds rate, that should impact the markets and make things a little bit more expensive. But the short answer is I don't see a whole lot of difference right now. I think that basically if you were in a position to buy a home or if you were needing to refinance your home, 3-4 months ago, that's still the same basic criteria.
So I thought when they passed the reform, I saw the interest rates jump.
So if they jump,
from
they jump slightly.
From 3.5 to 4.25 almost.
Yeah, a lot of the one thing that the market's really good at is anticipating where this administration is going. So we don't see big, huge moves on a given day right now. There hasn't been any major events that have happened that have surprised the market. That's where you're going to see real big changes in rates, like overnight or something like that, as if something unanticipated happened. Most of the people knew that the tax reform was going to come through in some variation. So the markets had already kind of priced that. Where the anticipation, though, is that doesn't mean there's not immediacy in terms of buying a house right now. I mean, if you're buying a house right now, as Adam could tell you because he just bought a house, and he buys lots of houses, but interest rates are low.
But he bought a house for himself.
He bought a house for himself. And
what you mean.
Interest rates are low, and it's a very great market right now for a buyer in terms of how much that money is going to cost you over time. There's still cheap dollars available. It's a good time to buy. So when we talk, a lot of times in the mortgage profession, we say, you need to act on this now. And most people that I've said that to, would look at interest rates and maybe they're an eighth higher, than they were a year ago. Is that a huge deal? No, but it's still a great time to buy, because there will be a time when interest rates will go, much higher than they are now. So
I can remember even when a 6.5 was considered a good rate. So.
Yes, and so can I. And
Which is crazy because that wasn't even that long ago, like when I bought my first house. So when the couple of concerns that were in that tax reform bill were to the average buyer and seller. One was that you would no longer be able to write out the interest on your mortgage.
Right, that's not happening.
Okay,
so that was preserved.
That's still a thing.
Would that be a federal thing or a state thing anyway?
Federal.
Yeah. Oh, it would? Okay.
Okay.
Because you deduct your state property taxes on your federal income tax return. You know what I'm saying?
Okay.
So even though it's a state fee, it's something that the federal government allows you to write off. So in our area, we're not impacted too much by the actual, things that are there that are negative, if you want to say it that way, because we do not really have high property taxes where we are. If you're in a state like New York and you're capped, I think it's $10,000 is the maximum amount that you can deduct for property taxes. If you're in New York, if you're in Illinois, like in Cook County or something like that, their property tax rates are so much higher that now they're panicking because that's going to mean, less money in their pockets when it comes to that, as far as a deduction. So, but in St. Louis, you really have to be, $1 million plus home pretty much to be up over $10,000 in terms of property taxes.
And and you can still write off the mortgage interest.
Yes, you can still write off the mortgage interest.
Okay, and so what about the capital gains, which currently is 2 years? If you sell your house prior to owning it for 2 years, you'll owe capital gains taxes. Mm-hmm. In that law, was it proposed 5 years, and is that something that's still being upheld?
Boy, that's a good question. I'm gonna have to
I think we got to ask our CPA these kind of questions.
Yeah,
but
CPA
because that's a big deal, and it's a big deal, I think, for first-time home buyers who maybe go into a home thinking I'll be here for maybe 3 to 5, and then come in and go, and then after 4.5 years go.
But usually they're gonna buy another house. That's the thing. Is like capital gains. Like when are you gonna owe capital gains? Are you gonna owe capital gains if you sell your home and buy another home? Likely not. Anybody who has a tax preparer is going to, help them, guide them through that, so they're not paying, tax on the money that they made, because essentially you're rolling your investment forward. I forget the technical term for that. Adam probably
1031.
1031.
Yeah, I bet
exchange.
the 1031 guys are chomping at the bits right now.
Right. They're like,
1031 is sort of a foreign term to a lot of people. I don't think I've never even done a 1031 like kind exchange, but I think it sounds like maybe a lot more of them will be happening if they go from 2 years to 5 years.
It may become a common thing if that's going to be a thing.
We'll have to ask the CPA about that next week when he comes in. Okay. It's interesting that you read that tax stuff, I guess, and you thought about how that would affect the mortgages. And
well, I think more the buyer, like a first-time home buyer who may not quite stay in their, they buy tiny homes thinking they'll upgrade when they start having families or something of the sort, or circumstances change, and they think that might be 5 years, but sometimes it's 4, sometimes it's 3. So it's
maybe they'll hold it as a rental or do a 1031.
Right.
I guess.
So I think it does kind of play into a lot of scenarios, but.
I mean, the bottom line.
Interesting to talk to him about this together.
I mean, what I always tell people about home buying, though, is that home buying's like the most base thing about it is it's a place to live. Okay, so that's first and foremost, right? Second most base thing about it is that it's wealth building. It's not, that person that buys a house, and yeah, you might have some taxes that you have to pay on that. You've still gained wealth by buying a property versus renting a property for the next 4 or 5 years. So I guess as just in a base ideology, I'd say that's the key there. So yes, I mean, obviously watching the news, different things that are going on, all will affect things slightly, but the base cause of buying real estate is to do what? To have a place to live, to invest in your future, to wealth build. Those root causes never change, and no tax policy is ever going to take away that advantage to being a home buyer. You know what I mean?
Well, that's very good. That's kind of like a rah-rah. You should
rah-rah,
buy a
house.
Thing, right?
Yeah, for sure.
This is so interesting to me being on the Facebook Live while we're doing this, because normally when we record our podcast, I know that maybe someone will listen, but now I'm literally I get the little notification of who's listening, so I'm getting used to this whole Facebook Live thing still. Next, you wanted to ask him about just kind of a general, quickly, what are the max concessions for buyers for the different types of loans? And when we say that, Shannon, you want to say what you mean by that? Closing cost credits, right?
Yeah, closing costs that the seller pays that the buyer requests within their contracts.
And let me let me frame that for a second, because people have always asked, buyers have very often asked sellers to pay their closing costs for them. And so this is nothing new, really, right? Or pay part of their closing costs or whatever. But with the recent changes to the Realtor contract, now they added the line on there where it's actually part of the contract where you're going to check a box and say, I want the seller to pay X dollar amount or X percentage of the sales price towards my closing costs, prepaids, and buy downs. And so this whole closing cost thing is just going to continue to be a big part of our deals. And it's going to be more and more important that we know specifically what the max allowable part is, right?
Mm-hmm. Right. It's always been part of the conversation, but now it will be it's in writing in the contract, new as of 2018. So I think it's...
Yeah, and this is something that I find, this is fascinating to me, and it has more to do with your industry than mine. But, the truth is in St. Louis, there's almost never a time where I see a contract that doesn't have some sort of concession from the seller. That's taking advantage of a market. So when you think about what's happening there, basically the person that's selling the home is selling it to somebody for less than what it will appraise for. I mean, that's the way to think about it. They are, let's say it's a $200,000 deal. They're going to give you 3% concessions. Really, they're giving you $6,000. They're really selling it to you for $194,000, even though it'll appraise for $200,000. That's fascinating to me just at the onset.
I guess I never really thought about it like that.
Even though it has to still appraise for $200,000.
Right, it still has to appraise, so it has to have comparables. And, I mean, when you're thinking about it, what's $6,000 really in value? I mean, an appraiser's going to go out, is this $194,000 or $200,000? Normally, there's not going to be that big of a difference. But what I find interesting, this is why I'm bringing it up, is that in other markets, it's not like that. People may ask for seller concessions, and the seller may say, no way. You know what I mean? Like, we're getting top dollar for this thing. Great example of that is I do deals in Colorado. In Denver, there is no concessions. And in fact, most sales are for more than what the asking price is and, more than what the house will appraise for. So what does that do? That makes a major appreciating market. But the bottom line is that is a seller's market. You know what I mean?
Yeah.
Buyer's market here, taking advantage of concessions, I think it's awesome because usually what it means is that you're getting more house than probably what you could afford if you weren't. I mean, as far as like your down payment. You asked what the maxes were. So, I mean, that's a good place to start. On government loans, FHA, USDA, it's 6%. On conventional loans, it's a little bit more varied. There's tiers, depending on how much your down payment is. So if you put less than 10% down, you can only get a 3% concession. If it's between 10 and 20, you can get a 6% concession. So that kind of is, and VA, which is important to talk about too, is 4% is the maximum concession on that from the seller. So I see them all the time. I think it's a great question because it is an advantage to buying a home too. Like when you think about it, if you're buying that house for $200,000, getting a 6% concession, you really got it for $194,000. And hey, you already have $6,000 in the home. You know what I mean?
Let me ask you quickly about the VA loan thing because
Sure.
So on the VA rider, it says something like the seller will pay buyer's closing costs required by lender, or it has some sort of wording like that. I didn't prepare for this question, but is that insinuating that on all VA deals, sellers have to pay all the buyer's closing costs?
No.
Because a VA buyer just is not allowed to bring any money to the table or something, or what's the deal?
So the reality of the VA loan program is it's meant to be 100% financing.
Mm-hmm.
You know what I mean? That's the bottom line. So is it 100% financing if there's $4,000 worth of closing costs? That's kind of debatable. You know what I mean? But
because they don't have to bring a down payment.
Right. But the seller can gift that, can basically do a concession for that $4,000 so that the person gets the 100% financing. Banks don't charge like bank fees on VA loans. They're limited to how much it can actually cost. That doesn't mean that banks try to charge people tons of money on other deals, but the reality is that VA is meant to be 100% financing, and God bless people that serve the military. It's awesome that we have that program for them.
So if they're buying a $100,000 house, is their loan like on day one $103,000?
It depends on the type of entitlement that they have. So, without getting boring people with this, if you receive VA disability, then you're exempt from what's called the funding fee for VA.
Mm-hmm.
So truly, it's 100% financing. You're not adding a fee for the VA.
Okay.
If it's a normal person, that's discharged from the military, then yes, they would have some sort of a fee. That's added to the loan, but not something they pay out of pocket. So, VA on refinances too is 100% financing. It's a pretty sweet program. It's great for people. Anybody who has a military background, that's the loan you should be looking into, and there's no doubt about that. So.
You gave me a formula one time, and I think it was kind of a rough formula, but it was sort of like what closing costs percentage will be. Like on a $100,000 deal, it's probably around 3%. 150, it's probably 3% plus 1,000 or something, but it's not always 3%, right? If you're buying a $500,000 house, your closing costs are not 3%. What's your formula for that?
So I like to think about where most people are. So I think 3% is a great number to use unless you're buying a house over $250,000. And then after that, your closing costs are going to be slightly less than 3%. And if you're under $100,000, they might be slightly more too. But that's just a good benchmark for people. The calculus it depends on every county, depends on every, what kind of insurance you get, whatever the other costs are. But if you go in anticipating that closing costs are going to be about 3%, you're right, unless you're buying a house for more than $250,000.
And when you say closing costs, do you mean closing costs including inspections, appraisals, survey?
So I don't include inspections in that. I do include appraisal. Inspections are, I've seen inspections where somebody got them done for $300 and one that somebody spent $1,500.
Right.
So the inspections could be running the gamut, and that's really your option. I don't require any inspections as a bank. Other than, like in certain instances, I would need a termite inspection. If it's a VA loan, that's the example.
And the seller has to pay for that.
Correct. That is true. So that's really the only time that I require anything here, unless you're in a rural area, you need well and septic inspection, stuff like that. So
Cool.
No, that's not included, but it can be. I can work that into the loan. If you need to stay under 3% and you need all that, then it can be done. You know what I mean? So.
Well, with that change to the contract now, I used to like to argue what closing costs the term meant.
Right.
but they added now it's closing costs, comma, prepaids, comma, buy down. So
Correct.
I don't have to argue that anymore.
And that actually, I think that's a better way to do it in a way, because in my mind, that is up for interpretation. Is the closing cost just the title fees? I mean, I've heard people say that.
I loved that. I loved arguing that because there was a separate paragraph called closing costs, and it listed out what all of them was, and it included inspections and appraisal and all that stuff. But some lenders, I don't know about you guys, but some lenders wanted you to say prepaids and buy downs, but it's in there automatically now. So
well, and I mean, I've actually had instances where a seller was like, I don't want to pay for their insurance for a year. Why would I pay for that?
Right.
But you agreed to give them 3%. What are we talking about here? You know, it's kind of my take on that. So
yeah, that's what's interesting about them adding that to the contract is that now will we be asking for closing costs more often? Maybe, I don't know. But your sellers that used to say, I'm not paying their closing costs kind of attitude, they are, I think, probably a little bit more likely to accept that as a normality since it's already like pre-printed into the contract instead of us having to handwrite it or type it in there as sort of like an extra thing.
Right. Yeah, and I think I think it's good just because it's full disclosure up front, right? So people can make a decision maybe quicker. And also I think it would be easier to compare, offers. With that. So.
Okay, so let's talk about getting a mortgage. Credit.
Yep.
What's
credit is part of it for sure.
Credit.
Yeah, credit, the job thing, money.
Right.
So what do people need to know? And I think more like on credit.
Okay,
I think it's been such a tricky.
Like you want them to start with what's your minimum credit score you have to have? Your minimum credit middle score you have to have, or what do you want them to talk about?
Yeah, I mean, what are the thresholds? So your minimum, where's the next threshold where you would get a better interest rate? Where's the next, the ultimate threshold?
Right. Okay, well, we could do a whole podcast on credit.
So just in a nutshell, those thresholds.
Yeah, so key components. I think actually it's kind of a shame that everybody doesn't learn about credit if it's going to be this important and people are going to, essentially have the option to buy a house or not buy a house based on it. That maybe
well,
we
and
should
not
have
just
more.
that, everything else is affected by your credit.
Sure.
Your insurance rates, your every move you make.
And I think
you think they should teach
getting
about
a
it
cell
in high
phone.
school.
Absolutely. I think that would be better than probably a civics class, although maybe we need more civics classes too. Sorry. But anyway, but no, I think the most important thing to know about credit is that a bank is trying to get to know you with a very quick operating system, and it's not perfect. So, it used to be you went to your local bank, they knew you were a farmer, Jeb or something, I don't know.
Jeb?
And,
Wow.
But whatever you were, and the bank knew you, but now you're going to somebody who has to get a picture of you without, just right away to know whether or not to make a lending decision to you. So, like a lot of times when people are skeptical about credit, I'm like, well, you're asking for a $200,000 loan. I mean, if you were going to borrow $200,000, if I was going to borrow it from you, would you want to know something about me?
Yeah, a little bit.
Exactly. So, but the most important things I think to know are that, ultimately credit can be, fixed. Like a lot of times people feel like they're trapped with a bad credit score. That's not the case.
And it can be fixed pretty fast.
It can be fixed fast. I mean, I don't think I've ever seen anybody who couldn't repair their credit within, a year to a reasonable rate.
There are some scenarios that might take a little longer.
Yep, and sometimes you can do it yourself. Sometimes you're going to need help. But the first thing is that it's like knowing that there is the possibility if you have damaged credit, you can get it fixed. There's no.
But I think the thing I've learned over the years is that it's best to talk to a lender because what you think you need to do is not necessarily what you need to do to raise your score the most.
So this is a common misconception is that if you have a cable bill from 10 years ago that's on your credit report, you got to pay it, right?
And it'll raise your credit.
And it'll raise your credit. No, that's not true. Credit really, so like the components are basically active accounts is important. Your history is obviously important. The amount of inquiries, the amount of people you're trying to get, a loan from, that matters. So what I always try to start with people is just find out how much they already know, because there's lots of information you can get online. You can read all about, the bureaus and this and that. But when I talk with somebody, I try to find out what they already know about themselves in terms of what they, have historically or whatever, and also try to educate them that really the best thing for you to do is to create positive things going forward. A lot of times living in the past is, just that. And you can leave stuff in the past in certain instances. You have to address things. But I think damaged credit people need to know that they can fix it, that it's not, a voodoo, that it's an algorithm, and essentially anybody can get their credit to a point of buying a house in pretty quick
So brass
order.
tacks, what's that minimum credit score?
Brass tacks. Well, there's not really a minimum credit score because there's instances where, you could have a situation. So USA, I don't, I want to talk more broadly, but we have instances where people don't have a credit score. Can you get a loan if you don't have a credit score? Yes. That's something that,
and
comes
just on
up.
the side note there, no credit is just as bad as bad credit.
Well, if you're
It's not
a
as
young
bad as,
person
but-
and you've never taken out a loan, then there are no credit options out there. Does that mean that tomorrow if you call me and you have a 450 credit score that I'm going to be able to do a loan for you? No, in all likelihood. But there are options. So the first thing is you got to find out where you're at. You know what I mean, and then go from there.
You can't give me a number?
I think I could. Anybody who wanted
Ideally, you want a minimum of.
So let's talk about where you're going to get really great pricing and great everything. Well, so the ideal buyer is for us is somebody who has paid their bills on time, that has low debt to income ratio, so meaning what you owe out there versus what you earn is low. Those are people that are going to be higher than, like, say, a 750 credit score. That's considered A-plus credit. You're probably going to get the best possible financing in that instance. But can I do a loan for somebody with a 620? Yes. Can I do a loan for somebody with a 580? Yes. What are the trade-offs there? Probably you're going to have less options in terms of down payment and
So 580.
Interest rate.
580 is I would
All
say.
that for 580.
Sorry.
Okay, Shannon, keep going down your list here.
Okay, so I think one of the questions that we get all the time, especially from first-time home buyers or even is what can I afford? I'm not really ready to even talk to a lender because that's always going to be my total response because that, I think, gives the best scenario and picture for someone to tell them what they could afford. But what if they're just not ready? They just want to start looking. How do they figure out what they could possibly afford?
Which is frustrating, by the way. If they say, oh, I'm not ready to talk to a lender, it's like that should actually be your first move. Because what if you called John and you find out you had credit fraud or
Right.
Things you didn't
anything
know
like that.
existed.
And so
yes.
all this time that you're avoiding talking to a lender
Yes.
while you're looking at houses, you could be fixing your credit during that time.
Or, yeah.
Sorry. Had to get on my high
No,
horse.
I do.
But which
totally
is why
agree with
we
that.
really do say talk to a lender because there are things that'll pop up that you don't know exist. But what I'm kind of going for is say someone makes $50,000 and let's do the actual.
So I might think about that.
Calculation.
I probably think about that a lot differently than probably. I mean, you probably get a different answer from any different mortgage banker you talk to about that. But the question I always ask people is, what are you paying now? Like, what is your rent now? Like, is the house that you have, fulfilling the needs that you have now? Is it like 2-bedroom, 1-bath? That's what you need to buy, So I like to give people an idea of, okay, if you weren't renting and you were buying, this is roughly the dollar amount that you could afford.
Like what your current rent would be if it was a mortgage?
So if somebody says that I spend $1,000 a month in rent, I'm like, well, you recognize you could buy like a $160,000, $170,000 house and have that same payment.
Okay.
I think that's a good way to think about things initially. But obviously, there's life changes that happen that necessitate buying something that's more than that. I mean, you're getting married, you guys are going to have kids, whatever the situation might be, where you might be going from spending $1,000 a month and now you're going to be spending $2,000 a month, because you want to live in this school district or whatever the instances might be. So I think affordability is, I would always start with what you're paying now to try to address that. But then, yes, we have ratios like in terms of what percentage of your income, should be allocated to a home loan. And those are safe harbor restrictions in lending. So we don't ever want to be in a position again where we put people in homes they can't afford. And the laws are written that way. And anybody who's in my business now, I mean, that's a A1 priority. And if it's not, they won't be in the business much longer anyway. So,
So can I ask you, one of the two things, I guess. Every time I work with a buyer, I like to tell them, first of all, I just want you to know that I'm never going to need to know anything about your money, and you should talk to your lender about that, because a lot of times I work with friends and family, and I think it's good for them to know that I don't need to know how much money they make or have or anything like that, right?
Yeah, most of the time we don't have a clue.
And I don't want to know. I don't want to tell anybody about my money stuff, so especially if I'm working with a friend, I don't want them to have to be like, yeah, Adam, here's my salary and, whatever. So none of my business. But I like to tell people, call your lender and tell them the monthly payment that you're comfortable with and figure out what mortgage amount that is. Right? Because just because someone can get a loan for $1 million doesn't necessarily mean they want to. Right. And so I think they like to know kind of what their max is. Mm-hmm. But I think I like to suggest to people that they come up with a monthly payment that they're happy with, and then you can help them figure out what sort of purchase price that is.
Yeah,
right?
So on my side, because people do let me know, all that stuff, I mean, I'm in the same position. When I tell people, hey, if you want your payment to be, $1,000 a month, you need to be looking $160,000, $170,000. Mm-hmm. But I also always let them know, but just so you know, I could actually approve you to $290,000. Problem I've found with that is that almost always what ends up happening is that people look at the houses now that are $290,000. Mm-hmm. So I don't want to really throw that out as, but I do think it's important to know what your threshold is. And, obviously grown people make grown people decisions. So, I mean, whatever people decide, it's not my job to
and what we're sort of not saying is that the difference between what you're willing to give them a mortgage for, or you're capable of, I guess,
right,
based on all these ratios and stuff like that, may not include some of their actual expenses, right?
Yeah, because, I mean, so just talking percentages, safe harbor in the U.S. is 43% of your income could go towards a mortgage. But, I mean, depending on what your other costs are, I mean, that might be way too high. It mm-hmm. might be really low. And then also, obviously, 43% of somebody who makes $600,000 is got a lot more available money than somebody who makes, $35,000. So,
can I ask? So, when you say 43%, as an example with credit cards, is that based on a minimum credit card payment, or is that based on what they generally pay on their credit card?
No, it's based on minimum payments on everything.
So if they spend like wild mm-hmm. and they pay it off every month, they pay $3,000 a month or whatever towards their credit card.
Right.
You're not considering that $3,000. You're considering that $150 minimum payment towards their debt.
Exactly.
And that's kind of where the difference is, I guess. Mm-hmm. They don't think about that when they go and buy the $290,000 house.
Right. Okay. Yeah. No, I mean, like I said, if it is interesting, because I've been through that many times where I pre-approve somebody, mention to them, oh, yeah, you could look up to this amount, and then they end up doing that. And I don't think there's anything wrong with that. That's something awesome, being optimistic about what the future is going to hold, too, But
yeah.
But I do think that, in general, going back to the original question, I try to give people options that fit what they want to do, where they want to be.
That's one of the reasons why we like you, is because I think our company culture is to help people make smart decisions in real estate, and not necessarily, we're not just trying to get the biggest commission we can by selling the biggest house we can.
Right.
And then having them be, having financial problems. So I think you're kind of come from the same
totally. I mean,
cloth or whatever.
I'm not a financial advisor, but I do try to learn a person's life and their situation and give them good advice. And I think if you're a realtor, if you're anybody in financial services, if that's not your main operating procedure, then you're not doing any service to your people. So,
any questions from our audience? Just submit a little question, type it up. I'm watching here. So let's try to do 10 minutes left. Shannon, get your best questions going.
Well, what do you want to know?
Put me on the spot.
So let's talk a little bit about sellers then, too, because there are a lot of options for sellers, like the bridge loan that I don't think people realize exists necessarily, because I think sellers are very confused. They want to upgrade, but they need that money from their house. And how do you close on the house and then turn around and buy another house? And does it all have to happen on the same day? And then it just becomes overwhelming.
And I've only heard of bridge loans by watching The Sopranos because it just wasn't something that was either popular or available in a really long time.
Right.
And so, but you mentioned them the other day that you can do bridge loans. Correct. Can you give, what is that, and like kind of give us the gist?
I think that a person's first move, being a home buyer, selling, buying another house, that's like probably one of the hardest transitions. Not that it's that much easier if you've done it 3 or 4 times, but navigating that in right now is pretty difficult. So a bridge loan, what it is it's essentially a loan against the house you live in now to help you buy the house that you want to buy.
A short term?
It's usually a 1-year loan. It's a second position loan. Basically.
But it's on the current house. So
correct.
How does that?
So it's kind of like a home equity loan?
Yeah.
Yeah, but
exactly.
then.
But you wouldn't get a home equity loan after you've already decided to sell?
Correct. So like if you have that house, so a bridge loan is, so most of the time when you're trying to pull cash out of your property, banks have restrictions that the house can't be on the market or couldn't have been on the market in the last, 6 months or 3 months or whatever. A bridge loan is designed for somebody who's looking to sell their home, has the house on the market, needs money for a down payment to buy their next house. So they take a loan against their current house to buy that next house.
So
this
it's using the equity in the house that
correct.
they currently have. So with that said, they have to have enough equity for this.
Correct. Yes. Yeah. It's not going to go over the value of the home, and in fact, it's pretty restrictive. Before the crash, bridge loans went to 100% of the value. You will not ever see that product again. That's just not going to exist.
Are they really just supposed to be using it for their down payment on their new?
Yeah, and I would tell you specifically, bridge loans are not necessarily for people that are buying their second home. Normally, bridge loans are for people that have a significant amount of their savings in their home. So like a retired person maybe who doesn't even have a mortgage then wants to buy another house, and they don't have, they're on fixed income or whatever. Those are going to be a perfect candidate for a bridge loan because basically they've got a ton of equity. They need money to go buy their next place. So, in retirement areas, people in that mode, you'll see a lot more of this type of lending, and it's a valuable thing.
That's why my dad's always asking about him.
He's always
he's
asking
a realtor in
about
that, above 55 kind
correct.
Of retirement type.
Yes,
community.
and those people can utilize that program, and it'll be very helpful to them. So I'm glad that they're back in a certain sense, but ultimately you still have to sell the house, because you have to pay off the bridge loan. You got to pay off your original bank if you had another loan. So, going back to the whole navigating though that second home purchase, because I have my age category, maybe I've got tons of people that are in that. I actually tell pretty much everybody who wants to look into buying their second house that really they need to talk with their realtor. So, you might be interested that there's a time where I'm saying, like you're saying, hey, go talk to the bank and find out. Well, when somebody's wanting to go buy their second home, I usually say, you need to talk with the realtor, get an idea of what your house is going to sell for, get an idea of what you may be clearing, after all the fees and everything, and that's kind of your starting point. So that's a way in which, we have a copacetic relationship, with
copacetic.
that.
Copacetic. Yeah, we appreciate that.
That's right.
So speaking of, especially those that are down the line, do you do a lot of reverse mortgages? Do you like them?
I've never gotten into it. I'd be glad to refer it out to somebody, but no, I'm not really. I think a reverse mortgage is great for somebody who doesn't plan on having a asset to hand down. So if that's the circumstances, that's maybe a good program, but I don't really aspire to tell people, hey, do a reverse mortgage unless you really just need to have no payment on your house.
If you get a reverse mortgage and you owe more on the property than what it's worth and you pass away, do your children have to pay the difference? The difference is gone?
Nope, it's wiped. Yeah.
Okay. Hey, let's make sure, by the way, let's get your info. Do you have to give your NMLS number or anything like that?
I don't know. Is this officially sanctioned event? I'm not sure. So
just give it just to be safe and give your contact info.
So my NMLS number is 188910. So my name is John Charlton. I work for USA Mortgage. My cell phone number? No.
Yeah.
You really want me to give a cell phone?
Yeah, have them call
All right,
yourself.
whoever-
My cell phone
How-
number is
contact
314-517-0262. So, yeah, call me. Oh, hey.
Okay. One more question, and then we'll do our 5 questions for everybody, and then we'll wrap it up for the night. What do you think?
Okay, what's your final question?
Oh, me.
Yes.
So is it still? I don't know if this is like my epic final question, but I'm curious about refinancing. Is this still a refi market?
Yes.
It is.
Yeah, certainly.
Because people still have 6s, or are you refinancing a 4.8 to a 4.5 or something?
So, the bottom line is interest rates are still good. So,
Yeah, but who's refining that hasn't already refied in the last few years?
yeah, so that's
Or bought?
So refinances are way down in terms of volume because there isn't as many people that have 6% interest rates out there anymore. But where it's still a good option for people is, it's way better to have mortgage debt than any other kind of debt. In my mind, I think in most financial planners' minds, because of the tax deductibility of it,
So you're saying people who
cetera.
are trying to roll in their debt?
Yeah, so cash
Into
out.
what?
Most of the refinances
Some of the
I've done
equity.
in the last 3 months have been cash out refinances.
And
But-
I had a friend that just did a refi because they pulled out a lot of equity from the house to completely redo a kitchen.
Sure,
And that's
a great
their
reason.
refi.
Yep.
Where do people refi if they want to
but
get
the
rid of
interest
their
rate
PMI?
was higher.
Yeah, getting rid of the PMI is still a big thing. I mean, if you have an FHA loan that might be around 5 years old, you're still paying a pretty high MI rate on those loans. So, could you get a better interest rate with eliminating the mortgage insurance? Yes.
So did you call us? We tell them what their home is worth. They figure out if they have 20% equity, and if so, then you can refinance them.
There's actually buyouts of MI even if you only have 5% equity. You can buy out of it like in a single premium. There's
Which
basically
would make sense to do if you plan on owning
living
your
there
home
forever.
for
Yeah.
many, many more years. Okay.
Exactly. And then the other thing is,
Oh,
is
you
like,
mean when they go to get the mortgage?
right.
Okay, yeah, the buyout.
Or now. He's saying you can buy it out now.
You can buy it out after you've owned the home.
Quit
you know.
paying $150 a month. You can pay
Sure.
$3,000 or whatever now. I'm totally making these numbers up.
That could be very close, and it might be that you're giving up some equity in the home. In other words, you're raising the amount that you owe, but you're recasting the loan, eliminating the mortgage insurance. There's benefits to refinancing for people, and then the other thing too is just like a lot of times people are in the wrong mortgage, and what I mean by that is they may have a 30-year fixed mortgage that's got a good interest rate. They're at 4.25%. But, they're going to retire in 10 years. Should they really have a 30-year mortgage? So recasting a loan on a shorter term is always a good option if you can lower the rate. Or just having a conversation and finding out what's the best thing for you. I mean, everybody's circumstances are different, and so, I always say, if you're curious about it, then have a conversation, and it doesn't mean that, that you are going to refinance for sure. And in fact, I love having conversations where I can tell people, especially previous customers, hey, you're in great shape. You're awesome. Stay right where you do what you're doing. And that's beneficial too, to know
I'm
that.
excited to say we have a question from a listener.
Oh, cool.
And the question is, what's generally the rate difference between a jumbo loan and a 30-year fixed rate mortgage, if there is a rule of thumb? And so that's her question. But while you're answering that, didn't the jumbo's numbers just go up or something like that?
Yeah, so truth is that they're pegged to pretty much the same indices, so rates should be pretty comparable. Last year, there was periods of time where jumbo loans were cheaper than 30-year fixed conventional mortgages.
Jumbo is what size? Above?
So that changed recently. So I think it's above 424,000 and some change in our area. But yeah, jumbo loans. I guess the point there, or the question there, is kind of, should you pay more down so you're in a conforming loan than stay in a jumbo? Well, that's going to depend what the rates are and whether or not where you're pulling that money from, and whether it makes sense to put a larger down payment down. And I hope I'm not misreading that question, but that's how I would interpret it. is that, you have the option of either putting more down to put it into a conventional loan or have a jumbo. And I would say that just depends on what rates the banks are offering.
And you used a word there, conforming. So I guess the whole concept of having jumbo loans is that they're just different types of loans.
Jumbos are just higher dollar amounts.
Right.
So
why is that non-conforming?
So what's meant by conforming is that it could be purchased by Fannie Mae or Freddie Mac.
Mm-hmm.
A jumbo loan is going to be serviced by the bank that holds it, and they're going to hold the debt on it. So those aren't saleable loans. They don't sell jumbo loans on the secondary market. And that's why banks, occasionally rates will be different on those. They may be higher now. I haven't priced one recently, so I couldn't tell you necessarily where they're at today.
I'm guessing they're usually higher because everyone was so excited when the jumbo amount went up. Mm-hmm. Right? The dollar amount of a jumbo loan was like redefined.
Yeah.
And they're like, oh my God, jumbos are up.
Well, that's why I was saying last year was kind of an anomaly that jumbo rates were lower.
Oh, they were lower.
Yeah.
Okay.
For a period of time.
So, yeah, in general, it's a higher risk mortgage for a bank, in certain instances, so they tend to have higher rates.
Okay, one more question from the audience.
Right on.
Quick question. Why do the refinancing terms vary depending on who you use?
Like the refinancing, the terms, I guess.
I think she means like if you call John Charlton or if you call some other bank or if you call your brother who's a lender in Idaho or whatever, like I think she means like when you talk to different lenders, why are the terms different? Mm. And probably also she means the rules, since this is my wife. I'm
I was like,
reading into it a little bit, but I think she also means like the rules when someone would say yes or someone would say no or whatever.
Yeah. Well, so there's lots of different types of banks, and there's lots of different people that do mortgages. There's lots of different types of companies and types of experiences you can have. So, I think it's good to shop mortgage companies, but really I think, mainly what you're looking for is a person that's going to take good care of you, do a good job, give you good advice, and ultimately tell you if they don't have the best deal for you too. And that's something that I think is important. So why would the terms be different, one mortgage company to another? Because we work for different companies, with different, I don't know, practices.
Pricing.
Sure, pricing can vary. I think like what's interesting to me is like what is considered a difference might be, interest rate is one everybody knows, but costs can be different. Like how much a bank charges can be different. Other types of terms might be different, too, outside of that. So I think the best advice I could give anybody is just to talk with people you trust. And if you don't have somebody, find somebody you trust. And then also, I think it's important even in that circumstance to check with somebody else, get a second set of eyes and ears on something, but have somebody you could go to that could explain to you the differences too. Because I've been in this business where two people had a 6.5% mortgage, but an APR on one was 7% and the other one was 9.5. Like people don't recognize that there can be differences other than just interest rate is my point. Anyway, hope that answered it, Molly.
Well, I guess basically what you're saying is like because people can charge whatever they want to.
Sure,
right?
It's a
and
business,
so
right?
If you buy lemonade from one street corner to another, it might be a dime here and a quarter there, and like because they can,
right?
One has more traffic or whatever.
And there are companies out there that believe that the cheapest is the best way to go 100% of the time, and there's consumers that believe that the cheapest is the best way to go 100% of the time. I'm not one of those people that believes that. I think that there's something to be said for having competition and different models, and it's a good thing.
All right, let's jump into let's wrap up the meat of the segment here.
Okay.
If that's okay, Shannon?
Go ahead.
We're going to jump into the 5 questions that I like to ask each of our guests. Okay, so John, who lives under your roof?
Under my roof? Myself, my wife Elizabeth, my daughter Joelle, my dog Sienna. That's it.
Okay. And I got that question from Trey. I think he framed it that way. I don't know.
Right on.
Where are you your best?
Where am I my best?
Mm-hmm.
That's a strange question. Where am I my best? With a beer in my hand on a beach.
That's where you're your best.
I second that.
100%.
That's where you get
Second
John,
that.
the best of John Charlton right there.
100%.
Okay, do you have a favorite blog or podcast? Are you like a book reader or a blog reader?
So I read a lot of books. Blogs, I'm not a huge blog reader. I read a lot of news. I don't know.
Where do you get your news?
I get my news from everywhere except for Facebook.
Okay, I'm like, I just sort of asked him a political question I didn't mean to.
Right.
What's your guilty pleasure?
Oh, man. These are brutal. I would say steak sandwiches from the Post on Fridays.
Okay, and who is your mentor and how have you thanked them?
Boy, that's a good question, too. I have a lot of mentors, like business mentor. Is that kind of what you're thinking, or personal mentor?
However you want it.
Well, I'd say my brothers are my mentors. I grew up with my mom and my 3 older brothers, and all of them kind of, had a different vision and had a different, kind of personality. And so they were kind of my 3 dads, so to speak, in a way.
How have you thanked them?
By love and gratitude, bro. You know what I mean?
Good. All right. Well, this wraps up our segment. Thank you, John Charlton. Thank you, Shannon St. Pierre, of course, for being here. And we got to thank Joey Vosevich, our producer of the best podcast.
Hey, Joey.
And now Facebook Live producer in the world. So thanks, everyone, for watching, and take care.